The Fed has made it clear that their goal is to slow growth in the economy, to lower inflation, and those two things usually, if not always, lead to a recession. And now that we're seeing stress in the banking system, not solvency stress, liquidity stress, credit conditions will begin to tighten. And these are things that happen right before a recession. So it's basically a given at this point that a recession will happen. The question is, how severe will said recession be? I think that it's not going to be a very deep recession. And the reason why is because we continue to see resilience in the job market. As long as there's resilience in the job market, we have more job openings than people who need jobs. It's very hard to have a serious depression or any sort of serious recession. The market is obviously got a lot of volatility and potentially further downside, but markets tend to bottom before recessions really start. So, it is a forward-looking indicator. And so we're likely to see continued downside pressure and continued stress in the markets as companies start to reevaluate how they're running their businesses. They start to tighten their belts, their balance sheet, their cash positions. Cost of debt goes up. These things will affect how companies run their business, which will slow the economy. But as long as we still have a tight labor market, it's very hard to imagine a scenario where we will have, a serious recession.